Hi everyone. Now investors are widely discussing the likelihood of monetary tightening by the Fed. Almost everyone is confident that the central bank is going to stick to aggressive rate hikes. Over the past week, speculators have been looking for clues on the regulator's decisions for the September meeting. The FOMC minutes did not stir up market volatility, although they were quite hawkish. At the end of the week, market sentiment was significantly impacted by the comments of Fed policymakers. Their hawkish speeches destroyed all hopes that a shift to a dovish stance. Therefore, speculators priced in again a more aggressive rate hike. President of the St. Louis Fed, James Bullard, backed a third straight 75 basis point rate increase at the next meeting. Wall Street ended last week in the red. It kicked off a new one with a gap down on futures for the US stock indices. Jerome Powell's speech at the Jackson Hole Symposium will be in the limelight. Investors want to get more hints about the Fed's plans for monetary tightening. Market volatility is likely to be high this week thanks to the release of a batch of macro stats. The economic calendar is quite eventful. Watch our video till the end and feel free to leave your comments down below. Let's start. Even though there will be more crucial economic reports, traders will remain largely focused on the Jackson Hole Symposium, scheduled for Thursday. Before the symposium, they could revise previous economic data to get one step ahead. It could help them understand what to expect from the symposium. The question is whether they will succeed or not. The regulator is always discreet when it comes to momentous decisions and future plans. However, sometimes traders are able to figure out the possible outcome of the Fed's meetings. Jackson Hole has become a place where the central bank has been announcing important policy changes in recent years. This is why volatility is likely to remain high at least until the end of this week. What to expect from Jerome Powell's speech? It's extremely difficult to predict given the mixed fundamental background. Some analysts stress that there is a dissonance in the Fed's signals. On the one hand, Fed policymakers have turned into hawks. They warn investors not to jump to conclusions ahead of time. The central bank has also stated that inflation has not peaked yet and there will be no short-term key rate cuts at the beginning of the next year. On the other hand, the long-term interest rates are very close to current levels and much lower than inflation. Thus, Jerome Powell is likely to confirm the Fed's commitment to aggressive tightening. The watchdog will continue to raise rates until inflation has peaked, returning it to the target level. As a rule, traders ignore such remarks. They seem to have finally realized that the shift to the dovish policy will not take place in the near future. Optimism on Wall Street waned following hawkish statements by the Fed officials last Friday. As a result, all three benchmark indices closed in negative territory. The Dow Jones declined by 0.16%. The losses were insignificant. However, on Monday, the situation changed drastically. The Dow declined by almost 2% during the session. For almost the whole summer, the US stock market has maintained a bullish bias. It appears stocks have lost drivers for further growth. Now stocks are gripped by uncertainty and anticipation of fresh economic reports and Powell's speech. Meanwhile, the technical indicators of the bond market show that the far end of the yield curve that reflects inflation expectations is growing again. The NRR indicator, which is the near end of the yield curve, remains at the same level despite optimism in stock markets. There has been a sharp decline in risk appetite in markets. Now traders prefer safe haven assets, especially in the US dollar. Perhaps traders are expecting the end of the current upward movement, so they are bracing for the new correction cycle. Nevertheless, stocks are unlikely to slide into the bear market. Traders have already factored in all negative events. For this reason, the stock indices will hardly slip to new lows. However, these are just predictions. There could be far more unexpected events ahead. The weekly losses of the S&P 500 were considerably bigger compared to the Dow. The index sank by 1.1%. On Monday, the intraday drop exceeded 2%. Notably, the US stock market began a corrective decline in the middle of the week. On Wednesday, the Dow Jones and S&P 500 indices decreased by 0.5 and 0.7% respectively. The S&P 500 slid below 4,300. As it failed to consolidate above this level, it fell further. A drop below 4,300 signaled a corrective decline to 4,100 on Monday. Will the index have to return to the bear market for a while? If there is a breakout and a decrease below the support level of 4,150, it may indicate a return of the price to the downward channel on the weekly chart. If so, the downtrend will persist. Its trajectory will depend on Powell's rhetoric at the symposium and whether he will answer the main questions of investors, or they will have to figure out the answers on their own. Traders want to find out how aggressively the Fed is going to raise the benchmark rate, how resilient the economy is, and whether they should expect quantitative tightening. Powell could again undermine bullish sentiment, saying that before the September meeting, the Fed needs to study a fresh inflation report and non-farm payrolls data. As for the economy, everything is rather complicated. The Fed believes that the US economy will avoid a recession. However, in their speeches, Fed members raised concerns about the resilience of the economy. The reports published last week revealed the weak points. Reports on housing starts and retail sales indicate a slowdown in the economy. A contraction in these sectors usually signals a looming recession. If the labor market shows signs of a slowdown, it will be a clear confirmation of recession. For this reason, the non-farm payrolls report, which is due on September 2, will be in the spotlight. The heavy tech NASDAQ 100 had a similar dynamic to other stock indices. It suffered the biggest losses last week, which amounted to 2.5%. It kicked off the new week with an intraday drop of 2.5%. The shares of tech giants such as Microsoft, Amazon, and Apple declined sharply on Monday. Netflix was among the companies that incurred losses yesterday. Its stock tumbled by more than 6%. Ford shares fell by more than 5% after the company announced that it would lay off 3,000 employees. It will have the company cut spending as it transitions to producing electric vehicles. That's all for now. Subscribe to our channel and stay up to date with the latest market news. See you.